In this video, we're going to explore how blockchain could disrupt the $140 trillion bond market and forever change how we buy and sell bonds. I will show you why this hasn't happened yet and when we can expect major changes in this market. Hey everyone, welcome back to the channel. If you're new here, I'm Przemysław, CEO of Espeo Software, a blockchain advisory company in the fintech space. We have been exploring tokenized bonds projects for some time now. With my insider look on how it's supposed to be designed and implemented, I want to share my views on this concept. As with any real-world asset, we can tokenize a bond, meaning we can take its legal details, the coupons, redemption date, ownership, and write them into a smart contract on a decentralized network. Before I explain the benefits of doing this, we need to go back almost 3,000 years to ancient Athens. This was the first time a bond was issued by a government. Since then, both central banks and corporations have used these financial instruments to finance international expansion, infrastructural investments, war, or to repay debt. Yes, if you don't know this yet, companies and governments go in debt to pay off other debt as well. Today, the global bond market is worth more than 140 trillion US dollars, which is more than the global stock market value and over 4 times the size of the US economy. What I found the most interesting was that until after the Second World War, the majority of countries did not have clear rules on when bond purchase or sale should be settled. This meant that the buyer and the seller were responsible for deciding how the transaction would be conducted and the duration it would take to be completed. As you can guess, the ownership transfer of securities was executed manually. The seller had to send the bond certificate by post or hand deliver it to the broker representing the buyer. The buyer would not make a payment for the security until they received the certificate. It worked the other way around as well. The buyer could not lessen his security until it was hand-delivered to another buyer. Since not everyone trusted the local mailman, they would usually hand these certificates themselves. In return, they received compensation straight away. Today, we would call such a settlement a T+0. However, with the increasing popularity of postal services and later the internet, governments around the world began to centralize settlement times to prevent the fluctuation of prices during the waiting periods. Most started with 5 days and later shifted to 2 and 3. Today, the majority of both government and corporate bonds have to be settled within 2 days through a clearing body. And this causes problems. Let me show you why. Let's say I want to buy a corporate bond at, let's say, a Polish debt securities market. To be more specific, I want to do it on Monday at 10 a.m. I place my buy order through my broker, it hits the market order book and executes 2 seconds later. That's it. I have the bond now, right? Well, not exactly. I can't do anything with that bond just yet. At 10:01, the central counterparty takes over the trade and sends the banks detailed instructions on how to settle it. The settlement date is Wednesday. That's T+2. Meaning banks now have 2 days to settle the transaction. Stick with me, because this is not the end yet. At 5 p.m. on Wednesday, the National Securities Depository and the National Bank of Poland move the bond into my account and debit my cash. Legally, I own it now. But the market is closed, so I can't sell it until Thursday morning. If I decide to sell it at 9:05 on Thursday, the sale will settle at 5 p.m. the next Monday and the money will reach my account on Tuesday the next week. 8 calendar days. I almost got a headache explaining this. Not only is this process extremely long, it is also extremely costly. There's research that proves tokenizing bonds could change this. A report by CashLink showed using blockchain can mean an 85% reduction in operational costs. That is because of a few characteristics of distributed ledger technology. With DLT, you can have atomic settlement, meaning the asset and cash transfer happen at the same time in one transaction. That completely removes the need for the traditional clearing process. There is no waiting, no counterparty risk, no matching across systems. Also, in the study I mentioned before, cashling assumes that the cash is tokenized in the form of stablecoins. That's crucial. If cash is already on-chain, you don't need external payment rails like Target 2. Settlement can become instant and borderless. In traditional infrastructure, cross-border settlement is expensive. Stablecoin doesn't care about geography. You're just moving tokens on a ledger, not sending funds across jurisdictions. Check out our video about stablecoins to learn more. The other source of costs are central securities depositories themselves. They charge hefty fees for things like coupon payments, call-put options, redemptions, and record keeping. But on DLT, smart contracts can handle all of that automatically. So if we manage to put both the corporate actions and settlements natively on-chain, we could cut the cost to 1/10 of what it was and shorten it by 99%. That's a strong argument for shifting infrastructure. But of course, the report assumes that we can buy a bond with on-chain cash, like a stablecoin or a tokenized bank deposit. It also assumes legal recognition of the token as the definitive record of ownership. The thing is, this is already happening. Until the day of writing, there have been more than 70 launches of tokenized bonds worth over $4 billion. So I mentioned the operational benefit of a DLT-based bond issuance process. However, I want to show you that tokenizing bonds also allows us to free up billions of dollars in collateral for investors. I will hand over the mic to Dominic to explain this in more detail.
With tokenization, you can pledge, substitute, and return collateral across venues almost in real time. The quicker the asset moves, the smaller the cash buffer dealer must keep. Today's systems slow that down because of three frictions. First, each custodian and central securities depository holds its own record, so every move needs messaging and reconciliation. Second, a bond tied up for one margin call stays locked until the end of the update. Third, swapping one bond for another often needs bilateral confirmation that can take hours. Tokenization can lift those sanctions. Let me walk you through another example. This time with an institutional investor. Picture Goldman Sachs International, which clears swaps at the London Clearing House and futures at the Chicago Mercantile Exchange. At 10:45 a.m., the London Clearing House demands £600 million in collateral to cover today's risks. Goldman posts conventional UK government bonds, which we call gilts. The gilts stay locked until their settlement at 1:30 p.m. However, the clearinghouse keeps the morning collateral in place until it is satisfied that no further margin calls will be needed today and that all payments have settled. That usually means waiting until the end of day margin run, well after 4 p.m. In the meantime, at 4 p.m., the Chicago Mercantile Exchange also needs to cover today's risks and demands £800 million from Goldman. Because their gilts are still tied up, the bank needs new collateral for coverage. So they now have £1.4 billion in assets pledged at one moment. The risk management team at Goldman requests the managers also have an additional 10% liquidity buffer to absorb timing mismatches. So now they have more than £1.5 billion in frozen assets. This timing clash would never be a problem if the gilts could be released the moment cash is settled. Picture Goldman Sachs International again, but this time the gilts have a digital twin that both clearinghouses accept. At 10:45 a.m., the London Clearinghouse calls for £600 million in collateral. Goldman pledges the tokenized gilts and the smart contract sets them to auto-release at 1:31 p.m. when cash settlements completes. At 1:31 p.m. the contract releases the tokens in seconds. At 4:45 p.m. Goldman pledges those same tokens to the Chicago Mercantile Exchange to meet its £800 million demand. Because the collateral moves instantly, only £800 million are tied up at any point. The risk team now needs just a 2% liquidity buffer, about £24 million, so total frozen assets fall to roughly £824 million, just more than half of what it was in our first example. The event repeats every business day, so the cost or the saving adds up fast. Freeing up close to £1 billion of collateral and buffer, this is working capital that can earn a return instead of sitting idle. At a 4% funding rate, Goldman's treasury saves about £40 million a year in interest alone. A report of Global Financial Markets Association, co-written with Boston Consulting Group, models how distributed ledger settlement lets dealers recycle collateral many times a day instead of once per day. The authors start from the about $19 trillion pool of high-quality collateral sitting in repos and margin accounts worldwide. If faster mobility frees up just half to 1% of that stock, $100 billion plus becomes available for trading or investment instead of lying dormant. Tokenization fixes the plumbing. By writing bond terms into a smart contract and settling with on-chain cash, we eliminate the two-day wait, cut back office spend by up to 85% and remove most counterparty risk. Fast collateral mobility could unlock more than $100 billion of idle assets every year, cash that can finally go to work. What's important is that this is not theory. More than 70 tokenized bonds launches worth over $4 billion have already hit the market. However, we still need universal legal recognition of on-chain registers and reliable tokenized money, but the rails are being laid and the pilots are scaling. If you enjoyed this video, watch our other content on the topic of tokenized assets, and as always, remember to stay on the block to stay ahead.